Hello, everyone. Welcome to day one of the Singapore Sidley Fest. You're with me, Olivia Higgins. Today, we have an exciting lineup of speakers for you to learn all about options trading. So come have a seat with us right now at the virtual table as you get your notes ready. Now, while we wait for a few more people to join us, I'd like to remind everyone that this session is for educational purposes only, and we are here to equip you with the tools to help you make better investment decisions. Let's get started. Today's topic, using options as a form of hedging. We are very pleased to have our key experts joining us from Nasdaq, OptionsPlay, and Futu Singapore, the Moomoo trading app. We will not only cover using options as a hedging tool, but we will also go into the options wheel strategy, risk versus rewards, the covered call, and some key analysis on the market right now, especially pertaining to recent events related to examples like Twitter and Netflix. Before we go into the live demo training, say hello to Nico Fazio, Yong Shern, Tony Zhang, and Jessica Inskip. Hi, everyone. Thanks for joining us today.
Hi, Olivia.
Hi, welcome.
Thank you so much for having us.
Hi, Jessica. Thank you for being on the session with us. Excellent. We're excited for the discussions we're about to have, and for the audience out there, would love for you to be a part of it. So get your questions ready, because we'll have the Q&A segment at the end. Now, we're about to have a presentation on options trading, but before we start, how about Nico and the rest of our guests? Perhaps you could tell the audience a little bit about yourself.
Sure. So my name is Nico Fazio. I'm in Nasdaq's US options sales group here in New York City. And you might be thinking, what does an options sales group do at Nasdaq? Because we're not actually selling options. We run exchanges and provide market technology. So what options sales basically does, and what I do in my job, is basically manage relationships with our global client base of liquidity providers, market makers, trading firms, and institutional clients. Basically to identify market structure opportunities, and to just make sure that the experience on our exchanges is going well. So my background is a bit of banking, consulting, and before this, I was actually at a Canadian derivatives exchange.
Great. Tony, hi.
Well, Olivia, thank you so much for hosting this fantastic event with Nasdaq and Momo. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. I'm one of the co-founders here of this particular company. We've spent the last 10 years building options technology and education to facilitate trading for both retail and institutional customers. And I have spent the last 16 years of my career as a market strategist working with traders, helping them better understand how to deploy these types of strategies for their portfolios. And the one thing that I've seen consistently over that time is really retail traders struggling to figure out how to navigate the complexities of options. There's simply too many options. And that's our mission here at OptionsPlay, is to try to make it as easy as possible. And that's what you'll hear me and Jess talk about today, is breaking down an option strategy, showing you exactly how the strategy works, some of the best practices for trading them, and how to implement them using some of our technology.
Amazing, Tony. Hi, Jessica.
Hi, Olivia. Thank you so much for having me. Yeah, I work alongside Tony. I am the director of product and education over at OptionsPlay. I've specialized really in taking complex elements and creating illustrations around them, and really making education easy to understand with those complex product offerings. My background is actually very heavily on the retail side with the engaged trader. I spent a lot of time over at Merrill and a couple of other brokerage firms, really in strategy and compliance as well. But nonetheless, I'm happy to be on the OptionsPlay team and really look forward to this session.
Same here. And what about you, Yong Shern?
Thank you, Olivia. Hi, nice to meet everyone here. So I'm Yong Shern, a corporate and institutional department senior manager, covering trading and business development solutions for Futu Singapore and international market. So I think personally, I have prop trading experience I have exposure in different products, so it is interesting for me to be here to guide everyone on the platform usage and also discuss about options trading on Moomoo trading app. Back to you, Olivia.
Thank you, everyone. We're about to have a presentation on options trading by Nasdaq and OptionsPlay, starting with Nico. The floor is yours, Nico.
Sure. Thank you, Olivia. So what role does Nasdaq play as an exchange in the options market? Because, obviously we talk a lot about options trading, but there's also, how do options transact, right? How are our markets set up, both in the US and globally? So Nasdaq powers 6 unique options exchanges, which trade both multi-listed options, so like options on equities and ETFs, as well as our own suite of proprietary index options, like the Nasdaq 100 index. So we as a marketplace provide technology that enables price discovery and best execution. So with the ultimate goal really that institutional and retail traders alike have a good experience trading options. So more literally, our exchange engines are matching buyers and sellers. The US options market is liquid, it's incredibly active, it's growing quickly, and it's kind of now on the global stage. And our platforms serve as the central risk marketplace for many of the world's most important companies. So, we take pride in being able to give traders all over the world confidence that their strategies can be deployed on our venues that are, transparent, fair, and performant. And then, as I briefly mentioned earlier, we have our own suite of index options based on the famous Nasdaq 100 index and are really continuing to innovate in this space. So we have our NDX index option, as well as NQX and XND, which are 1/5 and 1/100th of the Nasdaq 100 size, because the Nasdaq 100 is a fairly big index. And we're also excited to continue building across this complex soon with VolQ, a volatility index that's based on the Nasdaq 100. So why have options grown in popularity? And they really have. And there's a bunch of external factors at play here, as well as the fact that, our exchanges are, advancing in their own technology and capabilities. So, we saw an explosion of options volume globally in the last few years, but really, especially in the US. Some of the factors at play here, so retail brokerages dropping commissions just around before the pandemic was a driver of more general activity in the trading space, especially in retail. And there's also been, improvements in order execution quality and exchange technology. There's been more easily accessible investor education through many social media platforms, which has really driven activity here. And then on top of all that, markets have generally just been volatile too, which obviously helps with options volume. So, all these factors have not only led volumes to all-time highs, but they've really fostered more sophisticated options trading strategies over the last few years, which Tony is going to go into detail on later. And again, speaking of OptionsPlay, this is a great time to stress the importance of really investor education. And we're thrilled to be here with OptionsPlay. We think it's a great setup. April is actually Financial Literacy Month, so it kind of really works out, and we're excited to be involved. So a little bit more about Nasdaq exchanges. We've always kind of been an innovator in the options space. So for a little bit of history of our 6 exchanges that we operate in the options world, 2 of them were in-house developments, and then the remaining 4 were actually outside acquisitions. So one of these acquisitions was the world's first electronic options exchange, which is the ISE. We also acquired the Philadelphia Exchange, which still has a very active trading floor in Philadelphia. So while we are the largest US options group by volume, we represent about 1/3 of the US market in volume, we're still constantly really improving our platforms to optimize everybody's trading experience. So, you definitely want to take note that it's not just us, there's 16 options exchanges in the US. They're owned by 5 major holding companies, and everybody is competing through speed, resiliency, and throughput, to attract volumes. It's a very competitive landscape. Our technology really simply has to innovate in order to continue competing here. Some examples of this, late last year, we announced that our MRX exchange will be the first options marketplace to migrate to the AWS cloud, over a phased approach through the next years, which we're really excited about. Which finally kind of brings me into our technology. So, we operate exchanges in the US, and of course, we're very well known for both our equity and options exchanges in the US. But our tech is actually used at over 130 countries all over the world, or 130 exchanges, sorry, in many countries all over the world. So, liquidity providers, investors, traders all over, they rely on our technology. So while the US options and equities markets volumes have really grown over the last few years, we're super excited to continue expanding these matching engines and trading technology globally.
All right, so that brings over to the OptionsPlay segment. Thank you, Nico, for sharing that. It's very interesting how options have really grown in the retail space and something we've been seeing across the industry, and it's great to join in Moomoo. So we do have an important disclaimer on the OptionsPlay side, since we are going to go over a specific option strategy called the wheel strategy. It's something that's really grown in popularity and an income strategy that you can utilize with your portfolio to define entry and exit points, actually for an underlying stock or ETF of your choice. So we'll talk about that in a lot of detail. But from an OptionsPlay perspective, we do want to let you know that we are not a third party that's not affiliated with Moomoo or Futu, and we have a lot of examples here. They're not intended for individual tax or legal advice. So please keep that in mind as we go through this segment. So the real question that we want to ask here is, how can I maximize yield and participate in capital appreciation utilizing options? So that's the strategy that we're excited to share with you today. So what I have on the screen is an illustration of what we call the wheel strategy. So if you're familiar with the options, you know that there are essentially 4 individual legs that you can put together and combine and create various strategies. So with the wheel strategy, you actually utilize the obligations that are inherent with short options, which for the short put is the obligation to buy, and a short call comes with the obligation to sell. You utilize those obligations to define entry and exit points for the securities that you want to buy and sell. And what this does is it allows you to create continuous income by selling premiums. Once the option is assigned, or if it's expired, you continuously create that income. But once it's assigned, you buy the security, which the put has the predefined entry point. So that allows you to buy the security at a discount. Once you purchase the security at a discount, you can actually sell a call against that security and collect premiums. So you are participating in capital appreciation at that point. You define your exit point and you continue on that cycle until it's expired or you assigned and you sell the security. And that's what essentially we call the wheel. You've got a continuous cycle of selling puts and calls, buying and selling the security. And then you also have continuous cycles on either end where you're collecting premium along the way. So I do want to cover just the essential elements of what a covered put is and the components of this strategy, just from an educational and foundational perspective. So starting with a cash covered put, requires to have cash readily available to buy the stock or ETF. So essentially, if you've got the put for 100 ABC, you need to have enough cash available to buy 100 shares of ABC at your specified strike price. So say you choose $100, you'll need to have that available. When you sell the put option, that cash actually becomes the collateral for that security. So think of it like a limit order. If you've traded a limit order before, whenever you place a buy order, the cash that is required for that trade is set aside on your brokerage firm. So the cash covered put essentially does the same thing. That's the requirement on the cash side of the account. And what it does is it creates an obligation, because remember, we're on the short side of options. So you're actually obligated to buy that security at the discretion of the buyer of the long put. Remember, they own the right to sell. Since they own the right to sell, you are inherent of the obligation to buy. And what's really important about this is think of this from a risk perspective. When you're purchasing a security, the most that you can lose is the amount that you invested in this security. You'll notice that the profit and loss diagrams for cash covered puts and covered calls are inherent of that same risk. So you actually reduce the risk by bringing in premium because you're reducing the capital that is required to be put up. And we'll go over that in just a little more detail as we go through this presentation. And then real quick, I want to cover what a covered call is. So this line here represents owning the underlying security. So that's that risk that you have for owning XYZ stock, ABC stock, whichever security it is. You actually reduce your break even by selling premium against that security, but you also reduce and cap your upward potential. And that's a very important point. And a lot of questions that Tony and I get as we give this conversation is, how do I choose those strikes? How do I optimally execute this strategy? And that's something we're absolutely going to cover in a moment. But for the components of our covered call, so this is on the second end of that wheel strategy, you now own those optional shares of a stock or an ETF. You sell the call utilizing that stock as collateral. So again, like a limit order, when you put in a limit order, your shares are attached to it. The shares are attached to the covered call, and that's what makes it covered. And that creates the obligation to sell. So essentially what you're doing is utilizing these two strategies in such a way where you define your entry and exit points, participate in capital appreciation like you would when you own the underlying security, but you reduce your cost basis along the way and subsequently risk. So we've got an example that I'm going to go through really, really quickly that really just defines what this strategy looks like from the eyes of someone who purely trades stocks and stock and options utilizing the wheel strategy. So I do have this on my screen. So this is just a chart to give you a good idea of what would happen from the stock perspective. So if you were a stock trader and you wanted to buy this security, whatever your methodology is, you've decided you're bullish on the underlying security. And that's an important component of the wheel strategy. You are bullish on the stock. You're doing this on a security that you want to own. So if you were purely a stock trader, you'd enter a buy limit order perhaps at 50, where your entry point is on this chart, and 58. So you have got defined entry and exit points. If this were 100 shares, you're gonna risk $5,000 to make 800. So your risk versus your reward, which is an important component of this strategy. Looking at this from the eyes of the stock trader and the stock and options trader, I'll take you through this really quick example utilizing ABC. So if you're a stock trader, and say both start with $5,000, the stock trader is going to place their buy limit order to buy 100 shares of ABC at 50. It's going to cost them $5,000. The stock and options trader, they're going to utilize that obligation inherent with the put. And let's assume May 6th is 30 days from now. They're going to receive a credit of $3.15 per share, which is a total of $315. Remember, options represent, one contract generally represents 100 shares. They're going to receive $315 for that same obligation to buy at 50. So let's see what happens as this plays out. So the buy limit order is immediately executed. The ask was hit, so therefore they're going to purchase 100 shares of ABC. It's going to be worth $5,000 at this time. The stock and options trader now has an obligation to buy ABC at 50. That $5,000 is collateral like we utilized in that example. But what they've done is the break even of their security has now been reduced exactly dollar for dollar by the amount of the credit that they've received. And you can see how this plays out. Moving to expiration. So this option, ABC is at, excuse me. All right, so if ABC is at 51, it's up 2%. You can see that the stock only trader, they made dollar for dollar 2%. The stock and options trader, their obligation didn't kick in because remember a long put. So when you think about an obligation from an options perspective, it's easier to understand by looking at it from the long options holder. So the long put is the right to sell. Owning the right to sell at 50 is less advantageous than the market of 51. Therefore, the obligation to buy did not kick in this scenario. They retain their full credit of 315. With the wheel strategy, the next step is to sell a put again as long as you are still bullish on that security. So in this scenario, the stock and options trader turned their 5,000 and 5,315, made a total of 6%, 4% more than the stock only trader. So now they go ahead and sell another put. This time, increase the strike price to be at the money at 51 since ABC was up $1 there, 2%. This required collateral of $5,100, received a credit of $300. So the break even now was reduced by $3, but up $1 because we increased our strike price to 51. So you can see here how you create continuous income, and we're going to continuously lower that options break even point, and which essentially is the risk, utilizing the strategy to define our entry point for ABC. Going forward to expiration, ABC was at 50 in this scenario, so therefore that obligation kicked in to buy. Selling at 51 is more advantageous than 50. Therefore, at expiration, the put holder is required to fulfill their obligation if they do not close out those contracts. But in this case, we're okay. We welcome an assignment. That is the beauty of the wheel strategy. Naked options or options trading purely on their own, you essentially don't want assignment. You want to collect that premium. We're utilizing and capitalizing on that obligation in order to find the entry point, which is what happened here. So the stock only trader in this scenario, it's fluctuating. They're now flat, up 0% or down 0%, whichever one you want to call it. But the stock and options trader has still collected premium along the way, even though ABC is right where it began. So now that we own this security, you can see the variation there. Stock and options were now at 10%, the other flat. So now we need to sell to open a call and create that obligation to sell. So remember the stock only trader, we defined an exit point of $58 in the beginning. So they're going to create immediately a sell limit order. That's something you can certainly do if you want to set the order, define your exit point, and then just walk away. So this case, in this scenario, it's actually an open order waiting for ABC to hit 58 on the bid side before it's actually executed. The stock and options traders defined a strike price of 55, received a credit of 2. So this means when their obligation kicks in to sell at 55, which means the stock going up, then they were willing to sell their securities at $55, but reduce their cost basis along the way, as you can see with this chart on the right. So just playing out this scenario, wanted to give you another example of what would happen if it expired. Remember, a call contains the right to buy. So right now, if ABC is at $52, the right to buy at 55 is not worth anything, but buying at the market is more advantageous. Therefore, this option's expired. So on that portion of the wheel strategy, we are not required to fulfill our obligation to sell the security, keep the premium, and then we would sell another call in this scenario. But since ABC went up, and mind you, the percentages are based on the $50 movement, not the day movement, day by day. But you can see the stock trader made 4%. It's following along with the security, whereas the stock and options trader made 16% based on the premiums that they've received throughout this strategy. And then our last scenario that I'm going to give you is the call that's sold again. So remember, we want to define our exit point. So we're going to still keep that $55 strike price. We're credited at $2 for that in this case. So now we have an obligation to sell 100 shares at ABC at 55 if ABC were to move above our strike price of $55. And let's say we were all right in the fact, remember, this is extremely important, as you have to be bullish on this security if you want to implement this strategy. It's a stock that you want to buy. ABC went higher than our exit point, and that's also an important point. You're never going to define the highest highs and the lowest lows. However, you can certainly get a good idea, and exit strategies are important like we implemented here. So if ABC is up $10 from its initial $50 strike price, the stock traders immediately, limit order is going to go through once that bid hits 58. So they sold at 58, and the options was assigned. They sold at 55, receiving $5,500 as a result of the sale. And then you can see how the options break even and the stock break even really varied in the same time frame by implementing the wheel strategy. So the stock only trader made 16%, the stock and options trader made 28% in this scenario. And so this is really a great example of how you can utilize options for trading securities. So this is how options traders utilize short calls and short puts to purchase stocks at a discount, reduce the risk involved, and define entry and exit points with an underlying security. And I'll bring back that illustration one more time of the wheel strategy. So hopefully that added some clarification of what we threw at you there in the beginning, but you can certainly see the premium being sold to define your entry points, how that can certainly reduce your cost basis, allows you to reduce the price that you're purchasing the security at. Once you're assigned, you participate in that capital appreciation, define your exit point by selling a call, and then just continue in that cycle. So the next step in implementing this strategy is really defining optimal entry and exit points via the strike prices and chosen expiration. So I'm going to pass it over to Tony, who's going to show you how you can utilize some really great tools and resources to properly utilize this strategy.
Thank you so much, Jessica, for taking that deep dive into the wheel strategy and breaking down these two components of what is an important aspect of buying and selling securities, because ultimately that's what everyone is looking to do, is buy low, sell high. And the mechanisms to do so using options really can potentially provide a significant amount of income and outperformance using that strategy than outright limit orders. But in my 16 years of doing this, there's always a huge gap between the theoretical education, which is what we just went through using stock ABC at price at $50, and we teach that because options are complex, and when we dive right into some of the real numbers, it gets a little too complex right off the bat. So what we want to do is we want to talk about theory first. Make sure you understand the trading strategy from a conceptual perspective, then dive into the real numbers and dive into some real examples to show you exactly how to implement this particular strategy. And that's what I want to spend some time here today. So I'm going to use Cleveland Cliffs as an example, and I'm using this particular stock because it's been a pretty popular stock in 2021 going into 2022, especially as the equity markets have started to get softer. We've seen these commodity players get fairly strong. Cleveland Cliffs, one of the strongest in this particular space in the materials, iron ore space, still continuing to outperform the market, and is probably a stock that many of you may hold in your portfolio. And I have one thought experiment here that I want to show you. So let's say you own Cleveland Cliffs. Let's say you own 100 shares of this particular stock. The stock is currently trading just shy of $31 at $30.77. And as Jess was showing you, when you sell a cover call, you have to choose a very specific strike price. And that's a strike price that you would ultimately sell your stock at. So in this particular case, depending on which strike price you choose, you get different amounts of income. So if let's say you choose a $34 strike, that's about $3 above the current price. You're going to collect $1.41 in income. That's about 5%, 4.5% of the stock's value. That'll annualize out to 38% throughout the full year. If you choose a $36 strike, that's about $5 above the current price. That's going to collect 94 cents in income, which is about 3% of the stock's value. And if lastly, if you choose the $38 strike, that's almost $7 above the current price. That's going to collect 63 cents in income. That's about 2% of the stock's value, annualizing out to about 17%. And I want to ask the audience here, if you were looking at this particular strategy and you were trying to pick a specific strike price to sell, which one do you think you would choose? And I encourage you to type your questions into the chat window. Would you choose the 34, 36, or 38 strike price? Which one would you choose? I'll give everyone a second here to answer that question. And from the answers, what I can see is that we tend to find that most traders answer one of two. Most traders tend to answer either 34 or 38. And this is really where we've done a lot of back testing. We have tested every single S&P 500 stocks over the last, from 2007 to today, to test what different expiration date and strike prices provide the most optimal outcomes for this one specific strategy. And when we look at this specific problem, the answer is overwhelmingly clear to us as to exactly which strike price gives you the best outcome in the long run. That's exactly what everyone is here is trying to learn, right? Because it's one thing to understand the strategy. It's another thing to say, how do I actually implement it in my portfolio? Well, when we did the research, the overwhelming evidence is that the strategy with actually the lowest amount of income, the $38 strike that pays only 63 cents in income, is the one that will give you the best outcome in the long run. And most investors will ask, how is that possible? Why would I not choose the strike price that gives me $1.41 income? That's more than double the income. That surely must be better for me in the long run. But what you have to remember here is that for an extra roughly 80 cents in income, when you pick the 34 strike, the $1.41 versus the 63 cents, that's about an extra 80 cents in income. But what are you giving up for that 80 cents? And that's really the most important thing, because if the stock was to rally substantially over the next month or so, in Jess's case, when she was showing you the stock rallied up to 58, let's say this stock rallied up to 40 bucks in the next month or so. If you sold the $34 strike, you would have missed out on most of that gain because you've sold your stock at 34 bucks. So what you've done is you've basically given up $4 in upside, because the difference between 34 and 38 is $4. You've given up $4 in capital appreciation for just 80 cents in income. And that is a recipe that's not going to work out for you in the long run. So when you're choosing these strike prices for cover calls, it's very enticing to choose the strike prices that have a high amount of premium or high amount of income, because who doesn't want $1.41 versus 63 cents? But don't give in to that temptation. You want to prioritize capital appreciation of the stock that you own, which is the primary risk that you're taking with these types of strategies. You've deployed $3,000 to buy this particular stock. You want to make sure you get paid for that capital appreciation. So make sure you don't give up a significant chunk of capital appreciation just for an extra few cents in additional income. And I hope that makes sense, everyone. So please type 1 into the chat window if that makes sense to you, because this is one of the most important elements of this particular strategy that you need to learn before you deploy it for your own portfolio. And I see a lot of ones coming through on the screens, which is perfect. So now let's move on to the short put. Let's talk about a real example here for the short put. Jess, if you don't mind advancing the slides here, and I'm going to use American Airlines as an example, because the airlines have really taken a hit here during COVID. And I think that for some traders, this is starting to feel like an opportunity now to potentially look for opportunities in some of the airlines. And American Airlines, you know, one of the better operated airlines, certainly a lot of debt, a lot of leverage on the books. So perhaps this is the type of riskier bet that you might want to take. And you want to soften the downside risk here by selling a short put rather than owning the stock outright. Especially as oil prices start to moderate a little bit, maybe now you think is the right time to look at some of these airline stocks. And American Airlines is trading at $16.50. And I have the same thought experiment here. If you have the choice of different strike prices to sell for a short put, the $16 put collects 85 cents. The $15 strike price collects 52 cents. The $14 strike put collects 32 cents. And you can see the corresponding static returns. And if you annualize those returns over the full year, what they look like so that you can compare them apples to apples. I now, again, ask the audience here the question, which strike price would you choose? Type your answer into the chat window here. Would you choose the 16, the 15, or the 14? And this is really where we also did a fair amount of research backtesting this very specific strategy. We basically backtested every single possible expiration and strike price combination to see where do you get the best outcomes using this strategy to purchase a stock using a short put rather than buying the stock outright. Because to buy 100 shares of American Airlines would cost you $1,600.55. If you sold the $16 put, you're going to get an 85-cent discount on the stock purchase. And this is based on our backtesting. The clear, overwhelming evidence is that the strike price closest to the current price, in this particular case, the $16 strike price that collects 85 cents, is going to give you the best outcome in the long run. And this is because of two primary reasons. When you sell a put option, your goal is to own the stock. So when you select strike prices that are very close to the current price, you're going to have a higher probability of owning that stock. Think about a limit order. If you have a limit order to buy the stock at 16, or if you have a limit order to buy the stock at 14, which one has a higher probability of being executed? It's the $16 limit order. And that's why when you choose a short put, you actually want to choose strike prices relatively close to the current price. And the second reason that you want to choose a strike price close to the current price is because you get the highest premium. You get the most income, which means in this particular case, I'm able to buy American Airlines stock at a 5% discount by selling the put option rather than placing a limit order to buy the stock at $16. The two give me the exact same obligation, but one gives me a 5% discount. And that's 5% if it gets executed in the first month. If let's say I have to wait 2 months, meaning 2 cycles of selling puts before I own the stock, I could be owning American Airlines at a 10% discount relative to the stock investor. Those are some serious numbers. Think about if you were able to buy some stocks in your portfolio consistently at a 5 or 10% discount. What would that do for the returns for your portfolio in the long run? And these are significant numbers. A lot of people think about covered calls and cash secured puts as collecting 0.5%, 1% here or there. But, if you actually look at some of these names, especially some of the names that you might be interested in, you'd be surprised at how much yield that's actually incorporated in some of these specific strategies. So with that, what I want to do is I want to show you, now that I've shown you the strategies themselves and talked through the mechanics of how to actually deploy them, I want to show you some of the technology and research that we publish to our members every single day to help you find these opportunities. We have both a cover call and a cash secured put report. This report gives you every single list, S&P 500 name and liquid stock and ETF, and we sort it based on how much yield can you collect if you were to sell a cover call or a cash secured put following the best practices that I just taught you. Meaning if you're using a 45-day fairly out of the money cover call, how much yield are you going to collect on all of these names? There's about 800 names in this particular list. You can sort and search and filter through this specific list for stocks that you either own in your portfolio and you're looking to deploy a cover call, and it'll tell you exactly which expiration date and strike price you can choose and exactly how much yield you're going to collect on that cover call. And same thing for a short put. If you're using the short put report, it'll give you the opportunity to purchase these stocks at a discount. You can search through this list for stocks that you want to purchase or stocks that you currently have a limit order to purchase with, and see how much of a discount can I collect or how much of a discount can I receive by selling a put option rather than placing a limit order at the exact same price. So this is all updated for you every single day based on the most liquid names that we see here in the broader markets. And lastly, what I want to do is leave you with a few tips as to how you can take what you've learned here today and maximize yield. First of all, I recommend that you stick with stocks that you're familiar with and stocks that you're comfortable investing in. You should never pick a stock simply based on yield alone. Only invest in stocks that you understand fundamentally what the company does and understand what you're investing in. And if you want to simply try to maximize yield, our reports do that for you because it's sorted based on the returns. You can sort it based on yield, and you can see towards the top of the list which stocks are you familiar with, which stocks are you comfortable with investing, and simply pick the ones towards the top of the list. Those are the ones that will give you the highest returns. And many of you may be working with smaller accounts, and these strategies that we're deploying here today historically have been known to be some of the most capital intensive strategies, meaning they take a lot of money in order to trade. Well, you can also sort our reports based on stock price. There are plenty of stocks like Cleveland Cliffs or American Airlines that are in the $1,500, $3,000 range. So even if you're working with a small account, you can still deploy these specific strategies. And lastly, keep your eye out here on earnings. Earnings could be something that adds some volatility and adds premium to these strategies. So make sure you understand that our reports also shows you the earnings flag, telling you whether or not there's earnings between now and the expiration date of your strategy. And with that, I just want to leave you with just a clear understanding as to how you can find out more about the tools I showed you here today. You have a free, completely 30-day free trial here at OptionsPlay.com that you can see everything that I've shown you here today, including more education from Jessica and I. And with that, what I want to do is I want to pass this back to Olivia to talk a little bit about some of the other speakers and what they have to present.
Thank you to all our speakers, Nico, Tony, and Jessica, for that comprehensive presentation. Now, certainly useful and informative tools for our audience watching. We will be back with you in just a minute. Now, if you have any questions for the audience out there, do keep them coming, as we will pick some questions for you so that we can direct them to our experts at the end. And also, we're about to do a live demo training for you on how you can navigate options in our Moomoo trading app. So if you have your phone or your desktop in front of you, log into your app and follow through to learn with us. I would now like to invite Yong Shern back onto the floor. Hi, Yong Shern.
Thank you, Olivia. Hello, everyone.
Thank you. Thank you for coming onto the session, and we're excited to see what you have in store for us with the demo. Take it away.
Sure. So options plays an important role in navigating through the volatile stock market environment. With Moomoo, you can trade options easily anywhere on your fingertips with leveraging the functions and tools available within the app, including what I've shared earlier. So you can find earnings, options, options Greek, and a lot of more information. So without further ado, please allow me to share my screen. So hello everyone. So this is your Moomoo app. Hope all of you have logged in and follow me through the entire demo session. So just for the purpose of this live demo, we'll be using Twitter as an example. So now let's click into this counter, and at the top panel, click on options. And here you are in this option chains page. So you can see you have a lot of functions over here, including volume ratio. So this represents the traded volume for the previous trading day, which is clear that the demand or the traded volume for call options is higher than the put options. And over here, you can customize your display based on the information required. So you can input your options Greeks and other price information. This would be helpful for traders or even investors who would like to initiate an options view strategy, which have shared by our speakers, and also, based on your speculation activities or even some of your personal strategies. So this information will be very helpful if you can customize it. So just to remove those unnecessary and here you can also customize based on in the money, out of money, based on the display styles, which feel free just to explore this platform. And if you have any questions, just feel free drop your questions to us. So we will be able to answer to your questions. So let's move to the second tab, analysis. So in this page, you can analyze the options based on the volume by strike price. And you can also choose based on expiration date. You can go for May or even June. So you can also see open interest. And the next one will be volatility term structure. So if you're unsure about what is volatility term structure, just feel free to click on this information icon, and you get the definition. Same goes to options mount, volatility mount, and expiration. All right, so next, move to the unusual activities. This is one of my favorite part because I can, as I mentioned earlier, because I have got trading experience, so I personally like unusual activity to spot any trading opportunities. So these trading opportunities or unusual activities is not only limited to Twitter. You can use this limited filter function to filter based on your watch list for your US shares or even all stocks in the entire market. So there are more information, more filter functions, feel free to explore. Yes. Next, we have ranking. So this ranking, we can filter according to the traded volume, open interest, based on the underlying counter. Right, so now let's go back to the chains and just choose one call option for demonstration. Okay, in this main quote page, you will also get to see the basic information such as strike price, premium, multiplier, contract size, delta, all these options Greeks information. So BNIs, and I think this price calculator also plays an important role for you to gauge how undervalued or overvalued, or is it this option is priced at the fair value. Okay. So, okay, analysis. This is also another useful tool for you to navigate. In terms of volatility, this calculates the, because the volatility will also affects the price of the options. If you want to know more about this volatility analysis, just click on this information icon. You can also go by month or even 1 year price trend. Next will be option P&L chart. I think for those who are doing some strategy or want to get an estimation of your P&L or payoff, so this is a place to go, or even we have a combination of more than one option. And this probability of exercise. A lot of people like to ask, for option seller, they will ask, will my options expire out of money? I want to collect the premium for free, or those people who have bought the options earlier and they're thinking to exercise the option. So this is the place where you can, get an estimation of this probability of that particular options being exercised. So now back to the main page and hit the trade button. Okay, here is the place for you to choose the order type. We offer several order types for your options and equities trading. Okay, now input the price. Quantity. So you are unsure how many you can buy, you can always refer to the price information. In terms of your buying power on your this trading account. So the bid and ask price is also quite important. Based on my experience, we have come across a lot of options that the liquidity may not be that great, especially those are really out of money or still have some time to the expiration date. So to take note of this and make sure that you key in and order that is that price that favors to your strategy. For this dollar icon is for those people who are looking to sell options, such as selling call or selling put options without not doing any strategy but selling a naked call or naked put. Just click on this dollar icon and target to sell. You will get to see the initial margin IM required to initiate this position. So for this case, for this total, for this 6.5 call options, the initial margin required is $2,605.67 US. So if you want to thinking to initiate this position, just you need to ensure that your account have this amount of money, or maybe you could prepare more money for just to buffer for any fluctuations of this initial margin, just in the event of because currently the market may be a bit volatile. All right, so now let's click the buy button. This is just for demonstration only, this buy activity. Okay, so you can see your order status over here. Okay, or you can go to the main page, go to trade and go to trade today's order. And if you want to edit your order, click this. Otherwise, you can click cancel. So, I believe all of you have been wondering, some of you are wondering what is options Greeks, which I have mentioned earlier, or even some of the options strategies, and where can we get more education other than internally or externally. So for internally within the platform, you can go to Discover, go to Learn. So, I mean, for us, our internal team have prepared a lot of courses for you to kickstart your options trading or even your equities trading. So here's the place where you can get your options Greeks, and just bear in mind that you can always access this at your fingertip anytime, anywhere. So, right, just if you have any questions, just just drop us an email or maybe leave your question in the Q&A session. Back to you, Olivia.
Thank you, Yong Shern. So I just have a quick question to end this live demo. What is the amount of margin required to start selling a put option?
Okay, for selling put options, you can check. I mean, I have mentioned earlier. So in terms of the margin requirement for individual option, like put options. Okay, just now I was showing the call options. So let's go for one out of money and go to trade. So it's about 1,300 to kickstart selling put options, of course, but this initial margin for put or even call options will depend on the price of the underlying as well as the risk rating within the platform. So just, I mean, whenever if you feel like want to know about the margin requirement, just go to trade and click on the dollar icon. But I think with this amount of margin, it is very accessible to everyone to initiate your options view strategy or even other more sophisticated trading strategies. So yeah, I will stop my screen sharing right now. All right, back to you, Olivia. Thank you.
Thank you, Yong Shern. All right, I would like to invite our panelists back into the room for the most exciting part, and it is my favorite part, the Q&A and open discussion with our experts. Welcome back, everyone.
Thank you for having us back.
Thank you.
Thank you, Olivia.
So, I really enjoyed the presentation that all of you had for us. And I think for now, we would love to engage the audience watching because they've got some key questions for all of you. So the first question is for Nico. Why are people buying or selling out of money options? Does it mean it's worthless?
No, you can totally sell out of the money options. If it expires out of the money, then it's worthless. But before that, you can still trade them. So, and I mean, you know, Jessica and Tony will definitely be able to provide more detail here. But really, out of the money options, if you're buying them, they're going to be a lot cheaper, right? Like, so let's say if the stock is trading at $100 and you buy the option to buy it at $120, the value that you're paying is really for the time. And it's going to be very cheap. So that's why people buy out of the money options. Now they're more risky because if the stock's trading at 100, in order to make anything at expiration, it has to go to 120. But you know, they're a good way to really tap into a large notional value using like a very tiny amount of capital. But yeah, they're not worthless yet is what I would say. I don't know if Jessica or Tony, you have anything to add there.
What do you think, Jessica and Tony?
I'll just add that I think that generally speaking, you're selling out of the money options because they have high probability of success. Most traders want to trade strategies where you win more than 50% of the time. And naturally, when you sell an out of the money option, you have a greater than 50% chance of success. However, I do want to just caveat that with the fact that the further you go out of the money, the higher the probability of success, the worse the risk to reward if that trade goes south. You know, we've all seen some black swan events happen in the markets. You know, you think that you're safe by collecting $100, but on the back of that, you might be risking $10,000. You're just thinking I have a 99% chance of being right. That 1% of the time when markets really kind of break down, that could really hurt. So just be aware of your risk when you sell out of the money options.
Absolutely. Okay, next question. Jessica, would you like to add anything?
One thing on there, so thank you, Olivia. The probability of success of out of the money options is higher for the sell side. So I know the question was also geared towards the buy side. So that means the inverse is true. Your probability of not being successful is with those out of the money options. And that's what we utilize delta for in the Greeks, which are on the Moomoo platform there. That looked beautiful. So that's something I would encourage you to utilize when you're trading out of the money options, is looking at delta to define your probability of success if you're buying or selling.
Yeah, that's a great addition, actually, Jessica. I was talking about buying out of the money options. Tony was talking about selling out of the money options. So now you have both sides.
Yes, thank you for that, Jessica. All right, next question. We have seen an inverted yield curve in the past weeks. What can I do to help my existing equities portfolio? Open to the floor.
Okay, I'll take this question. So for this inverted, a lot of people are speculating that maybe recession is coming. So regardless of what is coming, we can always stay invested. And what's more important, to have options on our portfolio, such as maybe you could sell put options and for ETF options as well, and then to deploy some of the strategies such as options wheel, because when you sell put, you get to collect premiums, and just like placing a limit order, like our partners from OptionsPlay, we have, all of you have shared about to collect premiums, and while we're placing a limit order, so maybe you can get to lower down your cost price. Once maybe if you got to exercise your put options, we can do covered call to make even more. This gradually will decrease the cost price, as we are, at least none of us has the crystal ball to predict when the black swan event is coming. So options, if you're buying a put options, or you're doing the other strategies, I think this is something that for us to cushion some of the risks in the market.
Nico, Tony, Jessica, anything you'd like to add?
Yeah, I'll just add to that. An inverted yield curve historically, while being a strong indicator of potential recession, is not a particularly great timing tool. So, we may have a recession sometime in the next 3 to 12 months. So that in itself isn't particularly great in terms of understanding what to trade. But I will say there's one specific sector within the market that is far more sensitive to an inverted yield curve, and that's predominantly the major banks, specifically banks that generate most of their income from from interest margin. So if you look at names like some of the big banks like Wells Fargo and Bank of America, this is going to squeeze some of their profit margins, and that's really where I see some better opportunities using the inverted yield curve. Looking at either selling some call options on stocks that you own in that particular space to generate some yield and buy some downside protection, or perhaps even outright buying some puts in this particular sector as their profit margins get squeezed.
Mm-hmm.
That's beautifully said, Tony. Something I would add to that, an inverted yield curve is not necessarily a direct indication that a recession is coming. It's not directly after one another. And to Tony's point, it takes some time. On average, it's 12 to 17 months. So with that time into recession, if you look historically when this has actually happened, I don't know the dates off the top of my head, the S&P actually performs rather well within that interim that it takes to move into that recession period. So just know that it's not an indicator right away, and it certainly takes some time in monitoring of the market. It's just something to be aware of following your process.
Another thing that I'll add just right at the end here in terms of, practically going about these strategies. Let's say you want to trade options on like a certain bank or a certain sector that you want to tap into based on macroeconomic events. Just thinking liquidity wise and what's kind of practical, options are listed on pretty much most liquid equities and ETFs, as well as index options. Definitely it's good to be mindful of the liquidity of the asset that you're trading. So for example, let's say you want to trade a spread on a small regional bank stock. Options volumes are fairly a little more concentrated than equities volumes, meaning that a good chunk of options volumes are done in large ETFs, like the QQQ, for example, as well as large like tech stocks like Apple or Tesla or some of the larger banks. So if you're trading options on a relatively less liquid stock, it's good to probably use limit orders instead of crossing larger spreads.
Mm-hmm. All right. Sorry,
The
Yong
spreads
Shern?
are really dangerous because I have seen some of them. I mean, they complain in the forum that they place a market order, and when the market opens, the market order got filled, and they immediately lose about 95% of the value.
Right. Okay. Thank you, everyone, for that. Next question, directed to Nico, but everyone else, you're welcome to answer. In light of recent events over the past week, how can I help my existing tech holdings or position in Twitter or Netflix?
Right. So, bit of a disclaimer. As the exchange, I obviously, we're not trading, we're giving investment advice. Obviously, Twitter and Netflix are very, very liquid contracts, especially lately. It is kind of when I talk about like US options growth, and one of the reasons why the US options market was a big beneficiary of increased options trading in general is because the companies that are listed here are used all over the world, like Apple and Twitter and Netflix. Obviously, okay, so let's be objective here. Like Twitter is an interesting example. It's what you would call a special situation right now. And we tend to see more of these things in today's markets with how rapid information is and social media. And it's kind of ironic that Twitter is a social media platform and its prospective buyer is on Twitter talking about it. I guess actually maybe this might be a good idea I'm obviously not going to draw out any trading strategies on Twitter and Netflix, but if the OptionsPlay folks want to chime in as well, a good idea to talk about the concept of implied volatility, because, right before a big earnings report or in the middle of kind of a sticky situation with Twitter, options will become more expensive based on how much volatility, the market is expecting for that underlying stock. So an options contract is not what we call a Delta 1 contract. The underlying stock obviously really matters for the options contract, but there are other things that matter for options contract values. And one of the big components of an options contract is the expected volatility. For example, to buy a call on Pfizer is going to be a lot cheaper than to buy a call on Twitter relatively, because the market isn't expecting Pfizer stock to move as much. So I would say that if you are buying calls or puts in Twitter and Netflix, you might actually be paying a good chunk of what you're paying might actually be a volatility premium. And then after an earnings report, you might see what's called a volatility crush, where let's say calls and puts are very expensive before a big earnings print, and then the day after earnings were kind of normal and the stock didn't really move. Maybe the stock might be up a few percent or flat, and the value of your calls may have dropped. That's because you've lost a big volatility premium there. So again, can't really comment on specific single names. However, happy to discuss what role volatility plays in options.
Well, I'm happy to discuss individual names and individual strategies on specifically Twitter and Netflix. And I think these are great opportunities and great examples of how options traders can take advantage of this volatility and really sell premium. Specifically Jessica, her example that she used with stock ABC was actually Twitter in the background. So, for those of you that may have recognized that chart, but using that implied volatility, that's how she was able to collect, 6% of the underlying stock's value by selling a 1-month put and getting that 6% discount. So if you do want to buy Twitter and you want to buy it at the pre-Elon Musk levels, one of the ways to potentially do that is by selling premium. Same thing with Netflix. Well, let's see where the market opens today, but I think markets may have overreacted a little. Revenues are up, subscriptions are down, but revenue is up. That's really what matters, is how much money they make and how much revenue they generate. So I think a 20% decline is perhaps a little overvalued, a little bit overreactive. And I would be looking at selling puts or put spreads going into this type of event and taking advantage of that. And that's the distinct difference between an options trader and an equity investor.
Anyone else?
Something consistently. Yeah, something consistently we're talking about, Olivia, is always flipping it to the seller's side. You have a higher probability of success. Capitalizing on IV, we're going to collect more premium. If you're the buyer, you're really putting yourself in a difficult scenario. You're going to have to this underlying security is going to need to move more. And that's actually a common mistake I've seen with a ton of options traders when they first start. To Nico's point, is that implied volatility crush. They're going to buy options thinking that they're going to capitalize on a large move based on someone tweeting something or joining a board or whatever it is, the takeover, the poison pill, so many things that I am insinuating here. Nonetheless, the market's forward looking and the options reflect that. And that's the logic of it that I think is absolutely beautiful, is whenever there is a forward looking move or an anticipated move, it's going to be more expensive. It's that pricing component of options, because that's already priced into the premium of the option. You capitalize on that as the seller, but from the buyer, it's something you have to overcome. And so that question that I get asked a lot when people are first trading is, how come my underlying is not, or my option is not moving as much as the underlying or in tandem with the underlying? And the answer is due to implied volatility in those extreme circumstances. So it's really, really extremely risky when you are on the buy side of something with high volatility, because you have a lot of premium that you have to overcome in order to capitalize. So a lot of people end up losing and learn that lesson the hard way when they're trading options for the first time.
Excellent, Jessica. I think I would like to extend from that point, because I think a key question, you yourself brought it up during your presentation about risk versus reward. So what are some key opportunities and risks associated with options in a highly volatile market? Perhaps we can start with you, Jessica.
Sure. So I'd say with options in a high volatility market, I would want to focus on something that I understand first of all. So just investing in an underlying security or an option purely because it's trendy or volatile is mistake number one. You need to look at the components of it, and depending on the strategy, options can be structured in a specific way where they do, these individual legs kind of do exactly what they do. We've got lots of educational material on that. So the risk really depends on what side of the coin that you're on. So first of all, you have to define your sentiment of the security. I think that's an extremely important part. You need to understand if you're bullish, bearish, if you are seeking income. Those are probably one of the three things. And then you need to define your entry and exit points. That's extremely important as well. And that's something you should do if you're trading securities anyways, is defining those entry and exit points. So that's applicable in a volatile market, or whether you're trading normally in a regular market or environment, which the market is constantly changing. It feels like it's rather volatile more often than not lately. However, I think it's really important from a risk perspective just to define those entry and exit points, utilize a methodology, stay consistent with that, take the emotion out of trading, and that will certainly yield successful results.
Mm-hmm. Great point. I think an interesting point to bring up as well is, with the idea of opportunity and how people just move along with whatever trend comes into place. There's a lot of analysis on whether, for example, going back to the Twitter example, Elon Musk, was he really right about the true value of Twitter? Just an example. So, going back to risks and opportunities, Nico, we would love to know what you think on this.
I mean, from an exchange perspective, Twitter has certainly been trading a lot more, which, is a good thing. We like to monitor volumes over time and see what's popular. So we can curate our own product mix, right? I mean, our flagship proprietary index product is the Nasdaq 100 index. So like when you look at the TV, you'll probably see it quoted a lot, and you're able to trade risk on it. And I guess to my point earlier, it's the options market's awesome because you can do so much and you can really exact your focus into single names. But if your views are a little more higher level and you want to take a view on a specific sector, trading ETF options is a great experience. Usually the liquidity can oftentimes be a lot better, especially if it's a large ETF like the QQQ, for example. The ETF is naturally going to be a little less volatile than single names in the sector, just because it is an average of many names. I think that another way I can talk about this from an exchange angle is the whole like the Elon Musk and Twitter thing. Like, our exchanges have been put through an insane amount of like volume lately over the last few years. We're constantly breaking volume records. We're constantly breaking messages records. And one of the things that's often talked about in our market structure industry is how well the US options market's infrastructure is held up through these unprecedented times, right? So, we're confident that, if Elon Musk decides he wants to buy ExxonMobil next, that, the options will trade properly and in a liquid fashion. And we are happy to support like that robust trading activity with our markets. And over time, stocks will be like we get a ton of interest, obviously. I mean, look where we are. Like we're doing a panel in Singapore, and on Yong Shern's screen, like we were seeing a bunch of like US indices and that sort of thing. So our markets are full of companies that everybody all over the world uses, and we're just happy to provide the infrastructure that's needed to trade them.
Thank you for that. So we've got some technical questions come in. So I suppose going back to covered call, perhaps Yong Shern, you could take this. How can we engage in the covered call option on your platform?
So to engage in the covered call, basically you just need to sell an options that maybe up to a desired price. Maybe you want to sell out of money or very near maybe at the money because you anticipate the price may go down. So you just simply go to find the ideal option and click and hit the sell button. That's all. As long as you have sufficient underlying share to cover. Yes, for example, I think by default should be 100 contracts unless stated otherwise.
Okay, and will our positions and options be added into the watch list automatically from a user's perspective?
Yes, if you still remember during the platform demonstration, there's an option for you to click yes. So just to add this particular option into your watch list automatically. So there's not much operation required from your end.
And last question, will the margin requirement for selling options fluctuate?
Yes, it is, because our app panelists have shared the implied volatility. This will be one of the factors that determines the margin requirement for that option, and as well as the underlying price movement, given that we have seen that the price of Netflix or even Twitter have experienced a huge swing. So with this huge swing, that some of them may experience some of these options may require higher margin to maintain the position, given that it inherits higher risk.
Okay, so last question for our experts today. Someone would like to know, generally speaking, what are your personal, and I wouldn't say, I think we can keep it more general in this sense. What are your thoughts on, further thoughts on hedging?
So, you really should think about options as a way to mitigate risk. A lot of traders think of options as this risky product, something that you can leverage your capital, and you absolutely can, and you can lose a lot of money trading options. There's no doubt about that. But if you look at how institutions utilize options, look at how professionals utilize options, it is almost entirely in risk mitigation strategies. And there are many, many ways to mitigate risk. You can do it directly by buying put options to hedge your portfolio, but even thinking about selling a cash secured put and a cover call, that's mitigating risk and protecting downside risk for owning the stock. And if you get into buying spreads, those are also other ways to look at mitigating risk versus outright buying the stock or some type of other strategy. So there are many, many ways to reduce risk and hedge your downside risk. And that's ultimately why we use options, as strategists.
Anything else
Agreed.
to add?
Yeah, happy to add to that one. As we were talking, and your question earlier, Olivia, I apologize if I didn't answer that one directly, but what you're willing to risk in order for a reward. So a form of hedging, in my perspective, there is hedging against the market, utilizing put options and delta neutral strategies and things of that nature. But then there's also really just how much you're willing to lose. So your risk the capital that you're putting up and the reward
Appetite.
that's associated. Exactly. So utilizing options to reduce the capital that you're putting out or that you could essentially lose is a great way to mitigate risk. And that's something that we wanted to make sure we got across today. Absolutely.
Yeah. So options also can be used to create synthetic short positions. This is quite important for those who are looking to hedge their position, because not all the shares are considered as easy borrow. I mean, the big names are quite easy to borrow, but some of the exotic name, those clients may need to consider using options to create synthetic position, or even just outright buying or put options to mitigate the risk they have.
Thank you, everyone.
I can touch on one thing from the market structure side. So let's say you're bullish on a stock and you're really bullish, and equity is just not good enough for you. You want to buy a call option. You don't just have to buy that one call option. You can buy a call option with one strike price, and then you can sell a call option with a higher strike price. So basically you're creating, and you can look up, if you go on Google Images and type in bull call spread, you're limiting your risk, but you're still taking a substantial position. And when you put in these orders are usually called multi-leg orders. When you put in a multi-leg order and you buy it, like, those orders are executed as if it was one thing. And like on our exchange, like, we have tons and tons of great market makers and liquidity providers that are answering directly to these complex orders. So there's a lot of liquidity there, and it's a great way to very mitigate your risk in like a nice and easy way. And the market structure side of it is also really, really efficient.
Excellent. Thank you, everyone, for that panel discussion, and hope the audience out there enjoyed it. So for everyone, I would like you to just summarize your final thoughts for our audience watching today. Let's start with Nico.
Sure, I'll go first. This was great. I think that Tony really said it right. Like, options are risk mitigators, right? Like options protect you. They are tools. And it's true that buying call options or buying put options without any other component to the trade is risky, but options are leveraged, and leverage is a tool. And that's why they're so useful. So I think that's a main takeaway. I think understanding how an option is priced, in that options can be expensive. And if a stock is extremely volatile, the options you're not gonna know what's an expensive option if you just look at a $5 versus $7. Like, you need to understand how it's valued, and there's a bunch of ways you can do that. But a stock that is very volatile or always in the news or known not to be very steady is going to be, my approach today has usually been, it's going to be very expensive if you buy it, but it can also be really rewarding if you sell it. So understanding that options it's not just a buying game, selling options with the right capital commitments is super rewarding. And then lastly, options market structure is really, I think, the best it's ever been. Volumes are continuing to be quite high. US options markets are comfortably trading like anywhere from 35 to 40 million contracts a day now. The interest that we're getting from liquidity providers, both domestically and overseas, is through the roof. And we're just happy to continue working with our partners and innovating. So I think this was a great panel, and I was really happy to be a part.
Thank you, Nico. What about Tony and Jessica?
Jess, I'll let you go first.
Oh, all right. Thanks, Tony. So options are a great tool that can enhance your portfolio. That's what I would like to leave it with, is simply that statement. You can utilize options if you purely want to, for a long-term perspective or for short-term. You can capitalize on movements that are neutral, bullish, or bearish, as long as you take the time to understand the components and utilize adequate tools and resources. And that's extremely important, to utilize all the education that's available to you. And that's our mission at OptionsPlay, and why I really did join the company. Is that's my mission personally as well, is finding the adequate tools and resources to implement those strategies. And it's certainly something that takes time, but we want to make sure that those are available for you. And I think that's something that's extremely important, is just understanding how to capitalize on whatever portfolio or outlook that you have on the market or a security specifically. Hand it to you, Tony.
Thank you, Jessica. And I just want to thank the host of this session, Futu and Moomoo, and Nasdaq is our partner who brought us into this event. Olivia, thank you so much for hosting this event, and all the other speakers. What I want to just leave everyone with is the reality is, to learn how to trade options, watching this 1 hour session is not quite enough for you to go from just taking what you've learned and start selling cover calls and cash secured puts. But I hope that at the very least what we did today inspired you to dig a little deeper and realize what potential options has for your portfolio. And there are a lot of resources out there, whether you're going on Nasdaq or OptionsPlay or Futu. There's clearly education out there. Go and seek it. And because the world of options is extremely vast, there are so many different ways that you can use it, as Jessica says, to enhance your portfolio. And I hope that today we were able to show you some of that.
Yong Shern.
Yes, I mean, after education, I think everyone needs to start somewhere. And I personally would say start small. Start small, even start with paper trading after your education, after using the tools available, doing some back testing. Don't straight away thinking that option is a money-making machine. But with adequate of knowledge and practices, I think you can do well in selling options, or even buying options based on your back-tested strategy. So, I mean, just be mindful when you're doing your analysis. And yeah, I think just start small, because we have seen that people think that option is a money printing machine, and they start with maybe 70% of their entire net worth, and at the end of the day, they may not get the expected result. So just be mindful. But option indeed is a good tool if you have adequate knowledge and you have patience in terms of doing these options view, because sooner or later you will get, you will be able to see your result as long as you have a conviction towards the equity, provided the counters that you have chosen is a strong, with good fundamentals, good management, and is aligned with the industry trend. Don't go against the trend.
Once again, thank you so much to our experts for being on the panel today. Nico, Tony, Jessica, and Yong Shern for your key insights. And we look forward to having our next session together.
Thanks, Olivia, and everyone.
Thank you so much for having us.
Thank you.
Now, for the audience out there, tune into day 2 of our Sidley Fest tomorrow, because it's going to be a great one as well. And you'll keep learning just as much as you did today. More details will be found on our social media pages. And also, if you're interested, here's an exciting one for you. So we are Singapore's leading platform for zero commission US stocks. So if you're interested, there is a spinning the wheel chance up for grabs for you, and you get a chance to win a stock. Scan the QR code for more details. All right, we'll see you tomorrow. Once again, I'm Olivia Higgins. Have a great day.